Welcome back to Crypto Journal. And today we're talking about something that's going to challenge everything you think you know about how crypto assets move in relation to Bitcoin. Everyone in this space operates under one massive assumption. When Bitcoin goes down, everything goes down. When Bitcoin pumps, alts follow. The entire market is supposedly tied to Bitcoin's price action like puppets on strings. But what if I told you there's a project that could break that correlation entirely? What if I told you there's a fundamental reason why Zebec Network could climb into the top 30 cryptocurrencies by market cap, even while Bitcoin is bleeding through 2026? Stick with me because we're about to break down why Zebec operates in a completely different universe than most crypto projects, why its value proposition has nothing to do with Bitcoin speculation, and why the macro trends working against Bitcoin might actually be tailwinds for what Zebec is building. Let's start by addressing the elephant in the room. Why would Bitcoin be declining in 2026? We need to understand the bear case to understand why it doesn't apply to Zebec. Bitcoin faces several structural headwinds that could suppress price even as the broader crypto ecosystem matures. First, regulatory pressure is intensifying globally. Governments are getting better at tracking Bitcoin flows, at implementing reporting requirements, at restricting on-ramps and off-ramps. The anonymous freedom money narrative gets harder to maintain when every exchange requires full KYC and reports to tax authorities. Second, environmental concerns aren't going away. The energy consumption of proof of work mining is a political liability that creates ongoing pressure from ESG-focused investors and climate-conscious governments. Third, and this is the big one, Bitcoin's use case is narrowing. It's not becoming the global payment system it was originally envisioned to be. Transaction fees make small payments impractical. Settlement times make retail adoption difficult. It's increasingly just a speculative store of value, digital gold, and that's a much smaller addressable market than being the currency of the internet. Now, in a scenario where Bitcoin is range-bound or declining through 2026, most altcoins suffer because they're correlated. Retail investors flee to stablecoins or exit crypto entirely. Liquidity dries up. Projects with weak fundamentals get exposed. But here's the key insight. Projects with real utility, with actual revenue, with user bases that don't care about crypto speculation, those projects can decouple. And Zebec Network is exactly that kind of project. So what is Zebec? At its core, Zebec is a continuous settlement protocol. Instead of payments happening in discrete transactions, lump sums that move from one account to another at specific moments, Zebec enables money to flow continuously, second by second, in real time. Think of your salary. Right now, you work all month and get paid once at the end. With Zebec, you're getting paid every single second you work. The money flows from your employer's wallet to yours in a continuous stream. By the time you're halfway through your shift, you've already been paid for the time you've worked. You can spend it, save it, invest it, do whatever you want with it immediately. This sounds like a novelty until you realize how transformative continuous settlement is across dozens of massive use cases. Payroll is just the beginning. Think about subscriptions. Right now, you pay Netflix $15 at the start of the month, whether you watch it or not. With continuous settlement, you pay per second of content consumed. Watch half the month, pay half the price. The same logic applies to software subscriptions, cloud computing resources, streaming services, anything that's currently billed periodically. Continuous settlement creates perfect alignment between usage and payment. Think about vesting schedules for startups. Right now, employee equity vests in chunks, annually or quarterly. With Zebec, it vests every second. Think about freelance payments. Instead of invoicing and waiting 30 days for payment, the money flows as you deliver work. Think about insurance payouts, loan repayments, royalty distributions, affiliate commissions. All of these are currently limited by the infrastructure of traditional finance, which was built for batch processing, for settlement windows, for periodic reconciliation. Zebec eliminates all of that friction. Now here's where it gets interesting from an investment perspective. Zebec's value proposition has absolutely nothing to do with Bitcoin's price. It's not a store of value competing with Bitcoin. It's not trying to be digital gold. It's infrastructure for a completely different use case. When someone uses Zebec to stream their payroll, they don't care if Bitcoin is at 70,000 or 30,000. When a company uses Zebec to manage continuous vendor payments, Bitcoin's price is irrelevant. When a DAO uses Zbeck to distribute contributor rewards in real time, they're solving an operational problem, not making a speculative bet on crypto markets. This is the fundamental difference between Zebec and 90% of crypto projects. Most projects are building solutions looking for problems, creating tokens that exist primarily for speculation. Zebec is solving actual pain points in how money moves, and the token has real utility within that system. ZBC is used to pay transaction fees, to stake for network security, to participate in governance. As adoption grows, as more money flows through Zebec's infrastructure, demand for the token grows regardless of what Bitcoin is doing. Let me give you a concrete scenario to illustrate how this plays out. It's mid-2026. Bitcoin has been grinding downward for months. Mining companies are struggling. Retail interest in crypto is at multi-year lows. Crypto Twitter is a ghost town. Traditional altcoins are down 70–80% from their highs. But at the same time, Zebec has been steadily onboarding enterprise clients. A major payroll processing company integrated Zebec to offer continuous payment options to their clients. Several DAOs migrated their entire treasury management to Zebec's streaming infrastructure. A streaming platform launched a pay-per-second model powered by Zebec's protocol. None of these users care about Bitcoin's price. They care that Zebec solves a problem for them more efficiently than alternatives. As these real-world integrations compound, transaction volume on Zebec's network increases. Revenue flows to token stackers. The circulating supply gets locked up by users who need it for actual utility. Demand pressure builds from non-speculative sources. And slowly, steadily, ZBC's market cap climbs even as Bitcoin's falls. It's not moving opposite to Bitcoin out of spite. It's simply operating in a different economy, serving a different purpose, attracting a different user base. Now let's talk about why 2026 specifically might be a perfect environment for Zebec to break out. In a bear market, in an environment where speculative crypto projects are struggling, attention shifts. Investors and institutions start looking for projects with real fundamentals, with actual revenue, with users who aren't just speculators. Zebec fits that profile perfectly. It's not promising future utility contingent on mass adoption and network effects. It's delivering utility today to users who have immediate needs. There's also a macro trend toward automation and efficiency in how businesses operate. In uncertain economic times, companies scrutinize every expense, every inefficiency. Continuous settlement isn't just a cool technology. It's a meaningful operational improvement. It reduces accounting overhead. It improves cash flow management. It eliminates the float that sits in transit between payment initiation and settlement. For businesses operating on thin margins, these efficiencies matter. That's the kind of value proposition that gains traction regardless of broader market sentiment. Let's also consider the regulatory environment. One reason Bitcoin might struggle in 2026 is increased regulatory scrutiny on cryptocurrencies as speculative assets, as vehicles for capital flight, as threats to monetary sovereignty. But Zebec isn't positioned as any of those things. It's a payment infrastructure protocol. It's facilitating compliant business transactions, payroll processing, commercial settlements. From a regulatory perspective, that's much less threatening. In fact, regulators might prefer money to flow through transparent, auditable blockchain rails rather than opaque traditional systems. Zebec could actually benefit from a regulatory environment that's hostile to speculative crypto, but friendly to practical blockchain applications. Another angle is the shift in how crypto capital allocates during bear markets. In bull markets, everyone's chasing momentum, chasing narratives, throwing money at anything with hype. In bear markets, capital becomes more discerning. It flows toward projects with staying power, with business models that make sense, with teams that are building through the downturn. Zebec has demonstrated this resilience. They've been shipping products, signing partnerships, growing their user base without relying on token price hype to sustain operations. That's the kind of project that attracts serious capital when speculative froth clears. Let's talk about the tokenomics and why they support sustained price appreciation independent of Bitcoin. ZBC has multiple demand drivers built into the protocol. Every transaction on Zebec requires ZBC for gas fees. Unlike Ethereum, where high fees are a bug, Zebec's fees are designed to be minimal but consistent, creating steady demand as transaction volume scales. Staking ZBC provides yield and governance rights, incentivizing long-term holding rather than trading. As institutional clients integrate Zbeck, many will need to hold ZBC treasury allocations to ensure smooth operations, further reducing liquid supply. The supply side is also favorable. There's a capped maximum supply, so no infinite inflation diluting value. The emission schedule is transparent and predictable. A significant portion of tokens are locked in vesting schedules, so they're not hitting the market all at once. This creates a supply-demand dynamic where increasing real utility translates more directly into price appreciation because the available liquid supply is constrained. Now I want to address the skeptics who might be thinking, okay, continuous settlement sounds nice, but is there really demand for this? Are businesses actually going to adopt it? Fair question. Let's look at where adoption is most likely to happen first. The gig economy is enormous and growing. Freelancers, contractors, on-demand workers, they all face the same problem. They work today, they get paid days or weeks later. Continuous settlement solves this immediately. Platforms like Uber, DoorDash, Upwork, they could integrate Zebec and offer instant continuous payment as a competitive advantage. Workers would flock to platforms that pay them in real time instead of making them wait. The DAO and Web3 native organization space is another natural fit. DAOs already operate on-chain, already distribute payments in crypto, but they're using clunky manual processes or periodic payouts. Zbeck offers a native solution that's better in every way. Contributors get paid as they contribute. Treasuries can stream payments to multiple recipients efficiently. Vesting schedules execute automatically without manual intervention. The entire operations side of running a DAO becomes smoother with continuous settlement. The subscription economy is ripe for disruption. Consumers hate paying for services they're not using. Companies hate churn. Continuous settlement aligns incentives. Users pay exactly for what they consume. Companies get steadier, more predictable revenue instead of dealing with monthly retention cycles. It's a win-win that could reshape how SaaS businesses operate, how media streaming works, how any subscription-based model functions. Cross-border payments and remittances are another massive market. Traditional systems are slow and expensive. Crypto promises faster, cheaper alternatives, but most crypto payment solutions still operate in batch transactions. Zbeck adds another layer of efficiency. Remittances could flow continuously. Workers abroad could send money home in real time, eliminating both the delay and the accumulation of transfer fees. The point is, there are multiple enormous addressable markets where continuous settlement provides clear value. Zbeck doesn't need to capture all of them. It just needs to become the standard solution in one or two verticals to justify a top 30 market cap. And unlike most crypto projects that require network effects and critical mass before they're useful, Zbeck provides value to the first user, to the first company that integrates it. That's a fundamentally different adoption curve. Let's talk about the competitive landscape. Are there other projects doing continuous settlement? There are a few, but Zbeck has first mover advantage in terms of product maturity and integrations. They're already live, already processing transactions, already onboarding partners. They're not vaporware or a white paper. Execution matters enormously in crypto, and Zbeck is executing. They're also chain agnostic, which is crucial. They started on Solana, but have expanded to other chains. This multi-chain approach means they can capture demand wherever users are rather than being locked into one ecosystem's fate. Another competitive advantage is user experience. Most crypto products are still clunky, confusing, intimidating to non-crypto natives. Zbeck has invested heavily in making continuous settlement accessible. Their interface abstracts away the complexity. Users don't need to understand how the blockchain works. They just see money flowing, see their balance updating in real time. That focus on UX is what enables mainstream adoption, what allows Zbeck to serve customers who would never touch a DeFi protocol or manage their own private keys. Now, let's get into the specifics of how Zbeck reaches top 30 even as Bitcoin falls. Top 30 right now requires a market cap in the range of several $billion, depending on market conditions. For Zbeck to reach that valuation, we need a combination of things to happen. First, transaction volume needs to scale significantly. We're talking millions of payment streams active simultaneously, billions of dollars flowing through the protocol annually. That sounds ambitious, but remember, the payroll processing industry alone handles trillions globally. Zbeck capturing even a fraction of 1% of that market justifies a multi-billion-dollar valuation. Second, institutional adoption needs to accelerate. A few major partnerships with payroll companies, with DAO treasuries, with subscription platforms, those create legitimacy and drive compounding growth. Each major integration brings thousands or millions of end users who don't even necessarily know they're using Zbeck under the hood. They just know their money arrives faster, their payments are more flexible, their operations are more efficient. Third, the tokenomics need to continue creating by pressure. As more ZBC gets staked, as more businesses hold treasury allocations, as transaction fees accumulate, the available supply for trading decreases. Even modest demand increases translate to meaningful price appreciation when supply is constrained. This is basic supply and demand, but it's amplified by the utility-driven demand profile that Zbeck has. Fourth, and this is important, market perception needs to shift. Right now, most crypto investors still think in terms of Bitcoin correlation, still evaluate projects based on hype and narratives rather than fundamentals. But as the market matures, as institutional capital becomes a larger share of crypto investment, fundamentals start to matter more. Projects with real revenue, real users, real utility, they get revalued upward. Zbeck is positioned perfectly for that shift. Here's a thought experiment. Imagine you're an institutional investor in late 2026. You're looking at crypto as an asset class, trying to decide where to allocate capital. Bitcoin has been disappointing, grinding lower, facing regulatory pressure, not delivering on payment system promises. Most altcoins are speculative garbage with no real use case. But then you look at Zbeck. You see growing transaction volume. You see revenue generated from real economic activity. You see partnerships with recognizable companies. You see a protocol solving actual problems that businesses care about. Where do you put your money? You put it into the asset that has fundamentals, that has a path to sustained growth independent of speculation. That's the revaluation thesis for Zbeck. It's not about retail FOMO. It's not about memes or narratives or influencer shelling. It's about becoming one of the few crypto projects that institutional capital can justify holding based on traditional valuation metrics. Revenue multiples, user growth, market penetration, these are the things that serious investors care about. And Zbeck can tell that story in a way most crypto projects simply cannot. Let's also talk about the macroeconomic environment and why it favors Zbeck's model. If we're in a scenario where Bitcoin is declining, it's likely part of a broader risk-off environment. Maybe inflation is still a concern. Maybe central banks are keeping rates elevated. Maybe there's economic uncertainty driving capital towards safer assets. In that environment, businesses and individuals are more cash flow sensitive than ever. They care about liquidity, about accessing their money quickly, about not having capital tied up unnecessarily. Continuous settlement addresses exactly these concerns. It improves cash flow for everyone involved in a transaction. It reduces the working capital requirements for businesses. It gives individuals more control over their money in uncertain times. Traditional finance is also going through its own transformation. Real-time payment systems like FedNow in the US, similar systems in Europe and Asia, they're setting new expectations for how fast money should move. But these systems are still limited to fiat, to specific jurisdictions, to banking hours and business days. Zbeck operates 24/7, globally, across any asset that can be tokenized. As people get used to the idea that payments should be instant, the leap to continuous payments becomes smaller. Zbeck is riding a wave of changing expectations around payment speed and flexibility. There's also a generational shift happening. Younger workers, digital natives, they have different expectations about how money works. They grew up with Venmo and Cash App, with instant gratification, with real-time everything. The idea of waiting 2 weeks for a paycheck feels archaic to them. Continuous payroll isn't just a feature, it's an expectation. As this generation becomes a larger share of the workforce, as they start companies and make purchasing decisions, demand for continuous settlement infrastructure grows organically. Let me paint a specific picture of what mainstream Zbeck adoption looks like. A mid-sized tech company decides to offer continuous payroll as a perk to attract talent in a competitive market. They integrate Zbeck. Employees love it. They're getting paid every day, every hour, in real time. They have better cash flow, fewer overdraft fees, more flexibility. Word spreads. Other companies start offering it to stay competitive. Within a few years, continuous payroll goes from novelty to standard expectation in certain industries, the same way remote work options became standard after the pandemic. That's thousands of companies, millions of employees, billions in payroll volume flowing through Zebec's protocol. And that's just one use case in one geographic market. Scale that across gig economy platforms, across subscription services, across DAO treasury management, across cross-border payments. And you start to see how Zebec's total addressable market is genuinely massive. The protocol isn't fighting for a slice of speculative crypto trading volume. It's building infrastructure for how money moves in the digital economy. That's a market measured in trillions, and capturing even a small percentage justifies a valuation that puts ZBC firmly in the top 30. Now, I want to be clear about the risks and challenges because no investment thesis is complete without acknowledging what could go wrong. Zbeck faces execution risk like any growing protocol. Scaling to millions of concurrent payment streams is technically challenging. They need to maintain uptime, maintain low transaction costs, maintain smooth user experience as volume grows. Technical failures or security breaches could undermine trust and adoption. There's also competitive risk. If the continuous settlement model proves successful, expect copycats and competitors, including from well-funded traditional fintech companies. Zbeck needs to maintain its technological edge and its partnerships to stay ahead. Regulatory risk is always present in crypto. Even though Zbeck is focused on utility rather than speculation, regulators could still create obstacles. Money transmission licenses, securities classifications, compliance requirements. These could slow adoption or increase operational costs. And there's always the risk that mainstream adoption simply takes longer than expected. Businesses are conservative, especially around payroll and payments. Convincing them to adopt a new model on blockchain rails requires education, requires proof points, requires time. But here's the thing. These are execution risks and market timing risks, not fundamental flaws in the thesis. The value proposition is real. The problem Zbeck solves is real. The market opportunity is real. The question isn't whether continuous settlement is valuable. It's whether Zbeck can capture that opportunity faster than competitors and overcome the adoption curve challenges. Based on their progress so far, based on their partnerships, based on their technology maturity, I'd argue they're in a strong position to do exactly that. Let's bring it all together. Why can Zbeck reach top 30 while Bitcoin falls in 2026? Because Zbeck's value drivers are independent of Bitcoin. It's not a speculative asset. It's not digital gold. It's payment infrastructure. Its users are businesses solving operational problems, not traders chasing gains. As real transaction volume grows, as real revenue accumulates, as real adoption compounds, ZBC's valuation grows regardless of what Bitcoin does. In fact, a bear market environment might help by shifting attention and capital toward projects with fundamentals, projects that can sustain themselves through utility revenue rather than token sales and hype. The macro trends are aligned. Businesses need better cash flow tools. Workers want faster access to their earnings. The digital economy demands real-time settlement. Regulatory pressure favors utility over speculation. All of this creates tailwinds for what Zbeck is building. Add in favorable tokenomics, first-mover advantage, multi-chain flexibility, and strong execution, and you have a recipe for sustained growth that's genuinely decoupled from Bitcoin's price action. This is a bet on the maturation of crypto from a speculative asset class to a utility infrastructure layer. This is a bet that real-world adoption eventually overwhelms speculative correlation. This is a bet that solving actual problems for actual users creates sustainable value that the market eventually recognizes and rewards. And it's a bet that Zbeck is one of the few projects positioned to prove this thesis correct. So whether Bitcoin is at 100,000 or 20,000 in 2026, whether we're in euphoria or despair, Zbeck's trajectory is its own. If they execute, if adoption continues, if the use cases prove out, ZBC climbing to top 30 isn't just possible, it's probable. and for investors who can see past the Bitcoin correlation assumption, who can evaluate projects based on fundamentals rather than sentiment. That creates an asymmetric opportunity that's rare in this space. Thanks for sticking with me through this deep dive. If you found this analysis valuable, make sure you're subscribed to Crypto Journal because we focus on these kinds of fundamental breakdowns, on projects that are building real utility, on investment theses that go beyond hype and narratives. Drop a comment and let me know if you think Zbeck can actually decouple from Bitcoin or if I'm missing something critical in the analysis. And remember, none of this is financial advice. Always do your own research. But hopefully I've given you a framework to think about Zbeck and about crypto correlation in a completely new way. See you in the next one.